So it's the holiday season, and are you giving, or maybe you're on the receiving end of cash, a little gift of cash, right? That's like the gift that everybody loves. You can use it exactly how you want and have it freely be used at whatever store, whatever product, whatever anything that you want. Well, we often get questions about sort of the rules on that for the giver and the receiver. Is it taxable to them? Do they have to report it? What do I need to do? So we thought only appropriately to make that part of our conversation on this week's episode of Dollars and Cents. And then we're going to talk a little bit about a recent AARP article that talks about some of the bad things that you can do as a grandparent when it comes to your grandchildren, some financial mistakes that can be made, particularly around the holidays. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. So make sure you check us out on your favorite podcast platform of choice or our YouTube channel as well. Any trouble finding us, go to our newly designed website at Nelson Financial Planning. You'll see the icons. They'll get you immediately connected on over. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, two of which, Rob and Christina, are going to be hosting the show next week. They stand ready, willing, and able to help you change your life with a successful and cost-effective financial plan. So hopefully your holiday season this year isn't feeling too rushed. Certainly an odd year in terms of how late Thanksgiving was. That created sort of that shorter time span between Thanksgiving and Christmas. Of course, around the office this past week, our food and toy drive ended, and we want to thank all of those that contributed to those very worthy causes of Toys for Tots and Second Harvest Food Bank. We were able to once again this year make significant donations. And so we have you, our listening audience, our clients, our community to thank for all of the good work as well. Even though the toy and food drive has ended, our holiday offer of a free copy of our book, NextGen Dollars and Cents, and continues through the end of the year. So maybe if you are giving a gift of cash to a friend or loved one, maybe you accompany it with that book that helps to describe some of the various financial strategies to know to achieve financial success. It covers a range of topics from taxes to retirement to investments. It's all in there as a great resource. So make sure you check that out. Well, first things first. So an update from our topic of just 2 weeks ago, and it just underscores how rapidly things can change out there. So on the program 2 weeks ago, we detailed out the latest new regulatory filing for small businesses. It's the Beneficial Ownership Information Report, the BOI report, that is or was required to be filed by year end, detailing the owners of that company, along with identifying information of such owners, like copy of your driver's license or your passport or things like that. All of that had to be filed through the U.S. Treasury, courtesy of their Financial Crimes Enforcement Network, otherwise known as FinCEN. Had to do it by year end, and obviously required a variety of information. I think we shared with you that when I did it for Nelson Financial Planning a couple weeks ago, it took me a little over 15 minutes. So not incredibly burdensome, but, one more thing, if you will, that you have to account for, particularly if you're running a small business. Well, guess what? You don't have to do that. So the reality is that those of you who continue to procrastinate, not going to have to do that, or at least as things stand right now. And what's funny about it is that that was kind of our original position right from the very beginning. But we were getting, close to 30 days to the end of the year. So we said, well, okay, we don't want to be late. We don't want people to miss it. So we said, okay, this is a topic that we need to talk about. And but the late breaking development suspended this additional regulatory burden. So do some ongoing litigation over this out of a Texas court in a suit brought by Texas Top Cop Shop, Inc. The Texas court issued a nationwide injunction staying the requirement. So now, to the extent you want to do that BOI submission, if you own a small business, it's totally voluntary. And since that stay or that injunction wound up suspending all of the deadlines. So I guess we were right on what we thought might happen. Just needed to be, I guess, a little bit more patient. But 30 days out, we were like, well, there hasn't really been any development that suspends this or makes this voluntary, so we probably need to talk about it. And lo and behold, like a week later, there was this court case that suspended it. So I guess this is congratulations to the procrastinators out there. If you procrastinated or waited on filling out this BOI form, you can continue to do that because now everything has been suspended. Might that come back around? Well, yes, of course it might come back around. And that's, of course, why we do this show every week. It always amazes me how quickly things can change. And this beneficial ownership information report that is required of all businesses is another in that category. So you don't need to worry about if you procrastinated. Fantastic. You're off the hook. But stay tuned because it might very well come back. The other thing I happened to stumble upon this past week was a bit of an auspicious milestone. Officially, this past week marked the 5-year anniversary of COVID-19. So when you think of it, right, 5 years goes by pretty quickly. But on December 12th, 2019, and I guess they picked December 12th. I'm not sure why they picked that date, but that's what the internet says. So it has to be right? So December 12th, 2019, a cluster of patients in this faraway location called Wuhan, China, begin to experience symptoms of sort of an odd type of pneumonia-like illness. And, the rest of the story. But this milestone, this 5-year milestone of sort of the inception of COVID, coincides with a new study that was featured in the Wall Street Journal article that links this period of time post-COVID to a pretty good increase in market timing and correspondingly, unfortunately, a significant decline in investor performance. The conclusion of the study was that investors have exhibited much more detrimental trading behavior post-COVID than they were engaging in pre-COVID, taking sort of riskier bets, trading more inefficiently by trying to sort of time the markets and things like that. Bottom line, of course, as is always the case, this type of behavior where you're trying to time, I'm going to get in, I'm going to get out, obviously costs investors billions of dollars. And what was interesting about the study is it looked at the data for the 5 years pre and the 5 years post, and that gap between sort of actual performance and sort of realized investor returns literally doubled in terms of the post-COVID period of time. So we're going to take a break. When we come back from the break, we want to give you sort of the actual data and the actual numbers that this study concluded. But an interesting passing of the 5-year anniversary of the inception of COVID, which we'll talk about more after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. It's the holiday season, and we're talking a little bit about the auspicious anniversary, 5-year anniversary of COVID-19. Hard to believe that was 5 years ago when the first cases got reported. Technically, I guess the specific date was December 12th, 2019. These cases got reported out of Wuhan, China. How this relates to your investments is that there was a recent study done looking at the years pre-COVID, the 5 years pre-COVID versus the 5 years post-COVID. And the reality is that what the study determined was that investors as a whole during the 5-year post-COVID period have really experienced a pretty significant increase in taking riskier bets and trading much more inefficiently, which is obviously undermining investor returns. The reality is that market timing, thinking that you're going to hop in, hop out whenever, kind of your spirit moves you, is never a good strategy. And there's been a ton of studies over the years that have concluded that the reality is that if you're doing that, you are significantly underperforming and getting much less return than you really should be over time. Well, what the study also concluded is that gap, if you will, that performance gap of investor returns versus what the market is returning actually is widening pretty dramatically post-COVID. Pre-COVID, if you look at that period, that in performance gap in terms of what investors actually realized versus what investments did, investors basically were costing about a 0.5 percentage point per year as a result of that performance gap. Post-COVID, it over doubled to investors missing out on returns that were over 1% per year. And when you hear those numbers, you say, well, that doesn't sound like much. But if you take that out over a 10-year period of time, that means you got 15% less money at the end of said 10-year period of time, which obviously is material. Certainly seems like post-COVID, the willingness to make quick decisions or kind of looking for that quick buck has really spiked and remains high for investors and continues to remain high for investors. And what probably isn't helping, right, is the proliferation of resources that encourage active trading and all these internet forums, the Reddit, Wall Street Bets forum. I mean, all of that that comes with the hype surrounding that is not helping investors to actually achieve investment results. And obviously what the study concludes is that it has in fact been much more detrimental over the course of the past few years. So be careful with that. The worst thing you can do is think that you're going to hop in, hop out over time. You might get that right every now and then, but over time, it's going to have a significant negative effect on your performance. So it's the holiday season, right? And maybe you're trying to get your shopping done. There's always one or two people or more that, just impossible to buy for. Maybe you just don't have the time or you don't really have any ideas for it. So you resort to the one gift that, everybody kind of likes, that never goes out of style, and that is cash, right? Everybody likes that, spend it everywhere. But oftentimes we get questions on the tax implications of what those gifts might mean. So I want to dig into that a little bit in this segment of the program. And there's really 4 fundamental concepts that we've identified that we're going to spend some time talking about that hopefully will help you understand how this whole gifting thing works. Because we do get that question quite often is, what are the tax implications for me? What are the tax implications for the person that receives the gift? And ultimately, particularly more this time of year when people are more likely to give gifts during the holiday season. So the first concept that we really want to get on the table here is that Gifting and estate taxes are effectively viewed the same under the federal tax code. Basically, when we're talking about gift taxes or estate taxes, okay, those are taxes that you have to pay if you're moving money above certain limits to various people, right? That's the concept, is you can't just avoid taxation by giving your money to other people. A gift, right? If you think about it, a gift is something that you do, giving money, right, while you're alive. Your estate is effectively you're giving money, except you're dead. So the concept is, and the reason the federal tax code kind of thinks of gift and estate taxes as under the same umbrella is effectively whether you're dead or whether you're alive and money's moving from you to somebody else, that all is part of the same concept, if you will, from a federal tax perspective. Now, so when we think about it, everybody knows about the estate tax exemption, but that same number also applies to gifts as well. So today, that 13.6 million number is the amount that you can transfer to other people, whether it be during your life gifting or whether you're dead through your estate. Next year, that number goes to almost 14 million, 13.99. So if your Christmas gifts go over that amount, then, or, more than that amount passes to others on your death, right? Then you're going to owe gift/estate taxes. So if you're giving a gift that size, well, that's, good on you. But that's kind of how you sort of need to think about it. Gift and estate taxes are ultimately treated under the same umbrella for federal tax purposes. So when you hear that estate tax exemption of that 13.61 million, that also applies to gifts that you are giving as well. And so the gifts that you give in your lifetime ultimately reduce down that estate tax exemption that you get. So it's kind of like a running scorecard, if you will, where you get today you get 13.61 million to play with. And ultimately, if you're giving sizable gifts, then that 13.61 number comes down so that when you die, what ultimately is getting given to others then is capped out at that lesser amount. So bottom line on that, you need to think about the fact that estate and gift, same kind of concept from a federal tax perspective, and but you got to get above some pretty big numbers before there's really any immediate tax issues. So that's the first concept that we wanted to kind of start with in terms of talking about this. The second concept is that a gift is any transfer where if you're the giver, right, you don't get full compensation back for that gift, right? So cash is easy. If I give you $1,000, you're not giving me anything back. So that gift clearly $1,000. Where it gets a little bit more complicated, right, is if you're maybe giving somebody a share of stock or a mutual fund or some other kind of investment or real estate or a car. All of those can start to get a little bit trickier, particularly in those situations where something is given as a discount. The amount of said discount is the amount of the gift. That represents the gift. The part, in other words, the part you didn't get full compensation for. Okay, so that's kind of how that part works in terms of what the IRS looks at as a gift. So there's two other concepts that we want to talk a little bit about as it relates to gifting, particularly this time of year. So we're going to take a break. When we return, we're going to continue on this very topic here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're talking a little bit about gifts and some of the 4 fundamental concepts that surround gifting. And we get this question a lot, what's the tax implications if I give a gift to somebody? What's the tax implications to them if they receive it? Obviously, during the holiday season, that question comes up more often. So the first 2 concepts that we talked about in the prior segment, let's just recap those real quick. So the first thing to know is that in the eyes of the IRS, the gift and estate is sort of viewed the same, because when you think about it, a gift is when you give money away during your lifetime, when you're alive. Your estate is you basically giving money away except you're dead. And so the IRS looks at that in combination. And so when we think about the estate tax exemption, which today is $13.61 million, that's the same number that would apply if you were to give $13.61 million as Christmas presents this year, or if you die and $13.61 million goes off to your various beneficiaries. So just know that those are what you would refer to as unified concepts in the IRS tax code, gift and estate. So that's concept number 1 in terms of kind of how all of these things work together. The second concept, of course, is that a gift is you transferring something for where you're not receiving full value for that transfer, right? So if it's cash, it's easy enough. I wrote you a check for $1,000. You didn't give me anything in return. Easy peasy. It's a gift of $1,000. But let's say I give you a house or I give you a car or something like that. Then that's where you can start to then say, okay, well, what part of this is a gift and how does that all play out? So just know that the concept of a gift has to deal with this notion that as the giver, you're going to get less back than what you gave. And so the amount of that lesser amount then becomes the amount of the gift. So an important concept there. The third concept is that gifts to charities don't count as gifts. Those are donations. So you don't count that in the grand scheme of things. Similarly, and this is an exception I think many people forget, if you're making direct payments to a college and university, maybe you're helping your kid or your grandkid or whatever the case may be, if you're making those direct payments, those are not considered gifts either. Similarly, if you make payments directly to a medical provider on behalf of somebody else for a medical bill, then those aren't considered gifts either. So understand sort of the nuances of kind of what's a gift, what's not a gift, and these categories that aren't really in that category of gift, even though it involves you giving money to a third-party institution. The fourth concept, and this is another one that kind of pops up a lot, and sort of people get confused on it, is there is an annual exclusion amount. The annual exclusion amount is the amount that you can give to somebody in a particular year without having to report or file any type of forms with the IRS. In 2024, that number is $18,000. In 2025, next year, it goes up to $19,000. So what that means is I could give you $18,000 and there's no real implications. There's no filing. There's no nothing that needs to happen for that. If it's more than 18, well, then that's a different conversation. Where you can double the number up is through the concept of gift splitting if you are a married couple. So let's say you, listener to the program, my wife and I really like you, and we say we're going to give you a gift of $36,000. In that case, because I can give you 18 and my wife could give you 18, okay, 18 and 18, okay, that is your 36,000. So then, again, in that case, no need to file anything, nothing to worry about. Everything's great. Now, if your gift starts to go above those annual exclusion amounts, and of course, assuming that it is less than that $13.61 million combined estate and gift tax exemption that you get, or next year $13.99, then that actually would trigger taxes, right? If you're above those high limits of the 13.61 number, the reality is, though, if you're not at that number, but you are above the annual exclusion, so if you give a gift that's north of 18,000 but less than 13.61, then you would technically need to file a form. As you might well imagine, there's a form for that. And so that is IRS Form 709 that effectively reduces down that lifetime exemption amount that applies to both estate and gifts, and ultimately reduces that by the amount of the gift. That effectively is an informational return. If you're between north of 18,000 but less than 13.6 million, it's an informational return. There's no taxes or anything like that's due. Let me give you an example that hopefully ties all of these concepts together. Okay, let's say you and your wife decided to help your kid buy a house. Relatively frequent type of occurrence these days, because housing and things like that have really gotten out of reach for many sort of kids in that next generation. So you gave them $100,000, okay, to be able to do that, right? So the annual exclusion, right? You and your wife, so 18,000 per person. So there's two of you, so you could exclude 36,000 because that's the gifting, and that leaves you with 64,000. And so what you would technically do in that situation is you should file a IRS Form 709. Not going to pay any taxes on it, but what it does is it reduces down that 13.61 million number by the 64,000 of the gift that was given in this particular case, right? Remember kind of that first concept of how all of this gifting and estate is sort of combined together in the eyes of the IRS. So that's how gifting works. Confused? It's more complicated than I think. You realize all you want to do is write the check and cross it off the list that you didn't have to worry about it. But bottom line, here's the takeaway. The more you give, if it is more than 18,000 in a particular year, then you've got to think it through and kind of figure it out. And remember, a gift can be more than just cash. It can be, if you're selling them a home you owned and it's at a discount, if you're giving them a fancy car and or selling to them at a discount, the amount of that discount or the amount of the value that you are giving them that you're not receiving anything back for, that is the amount of the gift. And if it's more than 18,000, then you've got to file that informational report. If it's more than 13, now that informational report, you're not going to owe any taxes on it unless it is more than that 13.6 number, and then you might have to pay some taxes on. Think of it as a running total. You get to do whatever the heck you want to do with $13.61 million today. Obviously, that's a lot of money. Not many people are impacted by this one way or the other. But just know what those rules are, because that 13.61 number, that's going to adjust during the course of your lifetime if you're prone to giving gifts in excess of the annual exclusion. With that, we're going to take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're talking about giving gifts, an appropriate topic, given that it is the holiday season. The reality is that when you're giving gifts, sometimes mistakes can happen, particularly if it puts you on the road to spoiling the grandkids. According to a recent AARP article, they shared 5 such mistakes that grandparents make as it relates to grandkids and how they are treating them from a financial perspective. So only appropriate, right, during the holiday season to spend a little bit of time talking about that. Number one, obviously, right, you don't want to spoil the grandkids at your own expense. That one kind of makes sense, right? So don't give them an iPhone or the new iPhone if it would stretch your own finances. Better off kind of setting a budget and sticking with it. course, the real issue is, let's say it's the first grandkid, right? I mean, yay, first grandkid. But you got to be careful with the precedent that you set on that first one, because then the parents of the subsequent grandkids are kind of going to be expecting the same thing. So be careful with that. Maybe instead of money or a toy, maybe you engage in more of an experience, right? We got some great options right here in Central Florida. Big fans of the Orlando Science Center. That's actually where we just had our client appreciation event earlier this year. But a trip there is a good way to spend, is a nice gift to give, and a good way to spend time and enjoy an experience rather than just, here's another toy from Amazon that will be broken in a week. Or maybe that's making pottery, or all kinds of options. Okay, you don't need me to tell you what those options are. You can, kind of do some research, Google it, all that kind of stuff. But bottom line, understand that you don't want to spoil the grandkids, right, at your own expense. And you have to be careful about the kind of precedent that you set, particularly on the first one, because who knows, maybe you wind up with 10. Then, okay, that is going to have a financial impact. The next big mistake, according to this article, courtesy of AARP, is sort of not planning for money passing to the grandkids when you pass. Unfortunately, only about 1 in 3 people have prepared a will. But more importantly, if leaving money to grandkids, that comes with a series of pitfalls, right? Because the grandkids would generally be somewhat young when you might pass, and the question would be, can they handle it? Are they going to make the right decisions with that money? So certainly something to be thinking about from a planning perspective as it relates to your estate documents. The third item, another sort of common mistake, is setting up a college account. And this one we actually have seen quite a bit of. Setting up a college account or a prepaid college account, whatever the case may be, for the grandkids, but not letting the parents know, or not really communicating with them what you're actually doing. That can certainly lead to some confusion and some surprise down the road. I recall a situation where some parents thought that when their parents, grandparents, had said, "Oh, we're going to take care of setting up a college account." What they heard was that there would be enough money in the account to pay for the grandkids' entire college. But that's not what the grandparents meant. They meant they were setting up an account and putting some money in it initially, and the expectation was that it was going to be funded by the parents going forward. That lack of communication caused the grandkid to have a lot less options for college when that time came. So if you're going to do that, that is great option, but make sure you're having the conversation with the parents. Make sure everybody knows kind of what it is that you're planning on doing. Number 4, and this one really you got to avoid at all costs. Do not co-sign a student loan for a grandkid, okay? If there is a default, and maybe the kid stops paying it, they're too embarrassed, they don't bother to tell you because they don't want to, admit that they're not paying the loan that you co-sign for, you can have a portion of the loan that is in default be withheld from your Social Security check. So might not want that to happen. Best way to avoid that is don't co-sign a student loan for a grandkid. And then lastly, no harm in talking about your own finances. Maybe you don't have to get into specifics, but pass on your wisdom, what you did right, what you did wrong, some of the things that you've encountered along the way from a financial perspective certainly can help those grandkids as they begin to navigate life on their own financially. So certainly some important ways to avoid some of the common mistakes when it comes to giving money to your grandkids. So some important concepts there in terms of setting yourself up and setting them up for success, right? Don't overspend, set a budget, be careful about the precedent that you might set when it comes to the first grandchild or two. Maybe you have 10. Well, my goodness, then that is an awful lot of obligations that you would then have to do. And then take the time to make sure that you're planning for a potential inheritance. You don't want necessarily a bunch, someone in their 20s getting a bunch of money without some kind of restrictions on it. Take the time to share exactly what you're doing from a college planning or college savings perspective if you're planning on doing that. Don't co-sign the student loan. Don't do that. And make sure you talk about your finances and engage in that kind of information sharing based on what you have experienced. So another full show, right? We started off with the update on the beneficial ownership interest filing. If you missed that, the bottom line is that it was stayed courtesy of an injunction out of a court in Texas. So you do not need to file that report. It is now voluntary. That may change. And obviously, if it does, we'll keep you informed as to when that changes. But if you procrastinated on that, then lo and behold, you don't need to worry about that filing between now and the end of the year. And certainly an auspicious anniversary, 5-year anniversary this past week of COVID-19. Be careful if you are trying to trade your account, trying to market time. What the research is showing pretty dramatically is that your gap in investment performance is much greater now in looking at the 5 years post-COVID than the 5 years pre-COVID. I think a lot of that is the proliferation of some of these online forums and chat rooms and things like that. But be very careful with that. Remember, if you're trying to time the market, get in, get out, all of that. History's got a slew of studies that say you're not going to be able to do it that effectively over the course of time. And then that ultimately is going to cause your rate of return to be much less than it should be. And then don't forget about those concepts involving giving gifts, particularly now. There's the annual gift exclusion, but then there's also this concept that gifting and estate taxes sort of work together, and then all gifts don't have to be cash, right? They can be selling somebody a property at a discount, or giving them a vehicle or anything along those lines where it doesn't necessarily have to be cash. Couple exceptions to that: if you're giving money to a charity, that's a donation, that's not a gift. Or if you're making payments directly to a college or a medical provider, then that also is not considered a gift. So a lot of information in the program. We hope you enjoyed it. Next week, Rob and Christina are going to be doing the show. So a couple of the other certified financial fiduciaries at Nelson Financial Planning will be engaging in a lively conversation about a host of topics, as we do each and every week here on Dollars and Cents. So thank you very much for listening to the program. As always, if you have any questions at all, feel free to call us, email us, or even set up an absolutely free consultation with us at the office. To find out more, go to our website. It's nelsonfinancialplanning.com, and there you can learn about us, along with schedule that free conversation. And be sure while you're there to request a free copy of our book, NextGen Dollars and Cents. Thanks for listening to this week's program. We'll be back next week here on Dollars and Cents.